Imagine a situation. You've just bought a concert ticket for an amazing concert that you're very excited to see. You spent $200 on this ticket. It's an incredible ticket. You're going to get VIP seats to see your favorite artist and you can't wait. Now, it was a long way away when you bought that ticket, but now the date is getting closer. As a matter of fact, it's almost the date. Tomorrow is the day. However, there's a problem. You're now feeling a little bit ill. You can feel a sickness starting to come on. As a matter of fact, it feels quite bad. You're not entirely sure whether you're going to be able to recover or not, or you know that if you go, you're going to be feeling quite sick. Also, the weather report comes up. Oh my God, it's going to be hailing on that day. Not just raining, it's going to be cold and miserable, and it's going to be hailing as well. You may be sitting there thinking to yourself, oh man, but I spent $200 on this ticket. If I don't go, all that money's going to be wasted. And you're sitting there and you're looking at the ticket and you're like, but it's my favorite artist. I can't not go. Otherwise, the wasted money on this ticket, it's too painful. You keep looking at it and you're thinking, oh God, no, I have to go. I have to push through the pain. It's going to be a great experience. I'm going to be so sick afterwards. I'm going to be so exhausted. I'm going to be so cold. I'm going to be destroyed for work. I might not be able to get that promotion. You go to the concert anyway, even though you know that you shouldn't have gone. Now, the question is, are those costs that you incurred by fucking up your career and fucking up your health equivalent to $200? Would you have spent $200 to avoid fucking yourself up? These are the questions that circle around the entire psychological principle and the study of the sunk cost fallacy. Yes, we explored this in the lesson previously on psychology, but this is such an important principle in investing and trading that we need to revisit it again. Most people make this mistake when they first start out. This is one of those lessons that if you can get past it very soon, it will actually significantly accelerate your progress as a trader and an investor. I see this one all the time. People are constantly worried about the decisions that they should be making in terms of their previous entries and exits when they are a trader or an investor, forgetting that these numbers that they have in their mind, these losses or these profits or whatever it is, none of those make any difference. If you look at this diagram that I've put on the screen here, this is a fantastic example of how people's logic goes when they're dealing with the sunk cost fallacy. Take this dude, for example, with his anchor, right? It's like, oh my God, it's so expensive, but they're sitting in a paper boat. It's like the attachments of the past that will absolutely destroy you if you let it. This is the same principle that destroys most people when they're investing. They'll be in a loss, and their decision-making abilities will completely change depending on whether they would have actually entered the position, a fresh position at that point, or whether they would take it off. People's decision-making abilities, or more so their rationality, shouldn't be changing as a function of their profit or loss. The profit or loss is actually a backwards-looking measurement. The only thing that matters actually is the analysis of the position and whether or not you would be expecting it to continue going in your favor in the next period or not. You can see that in this sense, good trading and good investing is actually the deployment of a good skill or a good edge, and the profit or loss is merely a side effect of good execution. Personally, I found in my own trading and investing journey, the biggest hurdle from getting to the sunk cost fallacy mindset of a beginner, which can sometimes last for years if you're not careful, even when you know about it, to actually going to a professional mindset of understanding what the likelihood of what's going to happen in the next period is, or moving forwards through time, is actually going from what I like to call a deterministic mindset into a probabilistic mindset. This change is actually one of the largest and most significant shifts that a trader or an investor can go through. If you look at this chart, what you can see is the dark black line going through the middle. Often, new traders will believe that the path of a market is deterministic in this sense, in that it must follow a single path, and it goes up or down, and they may be looking at their position saying to themselves, well, if I draw a line on the chart, then it must mean that it's going to go up and that I'll be able to recover my losses and everything's going to be okay. However, professionals look at the market like this cone here, where they can see that there's actually a probabilistic range around their trades. So they don't know precisely where it's going to go, but they have a range of possible outcomes. Now, the reason why this is significant is because when you're investing, the only thing that matters is actually the probability of making profit in the next period, or the probability of the system that you're following making you a profit in the next period. If all up until the current moment you were placing random trades, and say you come into this university, but everywhere before that, you were just going long or short, buying and selling a whole bunch of random shit, and then you suddenly come into the university and we say now, okay, now is time to start investing professionally, so place the signals and then move forwards from here. You'll be saying to yourself, but all of my positions over here, they're still in a loss. Oh my God, I'm still attached to them. It doesn't matter, because from that current moment forwards, not only are you attached to the past and your previous failures, and that you cannot recover those by persisting using the same gambling mindset, but into the future, what I see and what the professors see as professionals is actually a probabilistic range of profit moving out into the future. We don't care that you have losses. We don't care if we had losses. Losses or profits are not part of the investing decision. Therefore, from the current moment forwards, the only thing that matters is running a system that has a positive expected profit, probabilistically speaking. This means that there is no version of you investing where it's like, I must get this trade right now in order to make my money back, because that is not a consideration. It feels like a consideration. Your emotions are telling you it's a consideration because of the number on the screen, and you don't like the idea of losing money. However, the market does not know how much profit or loss you do have. The market doesn't care. I don't care. Nobody cares. The only person that cares is you and your mind, because you're attached to that number on the screen. Moving forwards from this moment in time, the only thing that you can do is align yourself with the highest probability of success, and nothing that you can do can possibly recuperate your failures in the past. This is okay. This is how it's meant to be. And this is one of the reasons why it's so important to have a good, high-quality investing system that you can use that places the odds in your favor, so you don't become the gambler, you become the house. See you in the next video.